It was once the seventh largest company in America, worth $70 billion, the darling of Wall Street. 6 years in a row, named America's most innovative company. And almost all of it was a lie. In just weeks, it vanished, taking 20,000 jobs with it. Our story begins in Houston, Texas, in 1985. Two pipeline companies merged into one. They called it Enron. At its head, a soft-spoken visionary named Kenneth lay. Enron started simple. It moved natural gas through pipelines. But Lay dreamed of something far bigger. He wanted Enron to trade energy like stocks and bonds. To build that dream, he hired a brilliant young consultant. His name was Jeffrey Skilling, and he had a radical idea. Skilling believed Enron shouldn't just sell gas. It should become a giant trading machine for energy itself. Wall Street loved it. The stock began to soar. Enron became the hottest company in America. Its traders were treated like rock stars. But Skilling had introduced something dangerous. A new way of counting money. It was called mark-to-market. And this one accounting trick would quietly rot the company from inside. To see how, you need to understand one simple idea. Normally, a company records profit when the cash arrives. Mark-to-market let Enron do something else entirely. It could book years of future profit today. Sign a 20-year energy deal, and Enron claimed all the profit now, even if that profit might never actually arrive. On paper, Enron looked unstoppably profitable. In reality, real cash was running dangerously low, and the company was taking on enormous hidden debt. To hide it, Enron turned to its chief financial officer, a financial wizard named Andrew Fastow. Fastow built a web of secret companies. They had strange names: LJM, the Raptors, Chuco. On paper, they looked like independent businesses. In truth, Fastow secretly controlled them. Enron shoveled its debt and losses into these shadow firms. And just like that, the debt disappeared from the books. The numbers looked beautiful. The truth was buried. Fastow even enriched himself through these deals. By 2000, Enron's stock hit an all-time high. On paper, the smartest men in the room had won. But a machine built on illusions needs one thing to survive: a stock price that never stops rising. And in 2001, the rising finally stopped. Then one insider did something almost no one dares to do. In August 2001, CEO Jeffrey Skilling abruptly resigned. He cited personal reasons. Wall Street was stunned. Why would the captain leave a winning ship? Behind the scenes, a senior executive was terrified. Her name was Sherron Watkins. She had studied the secret entities and was horrified. She warned Chairman Ken Lay in a now-famous memo. Enron, she wrote, might implode in a wave of accounting scandals. She was right. The cracks were becoming canyons. In October 2001, Enron shocked the market. It reported a $618 million loss. Then it wiped over $1 billion off its own value. The hidden entities were finally dragged into the light. Investors realized the profits had never been real, and the regulators came knocking. Enron's stock went into total freefall. From $90 toward a single dollar. Panic swept through the company's Houston tower. And at its auditor, Arthur Andersen, something darker happened. As investigators closed in, the shredders ran for days. Tons of Enron documents were destroyed. It was a desperate attempt to bury the evidence. On December 2nd, 2001, Enron filed for bankruptcy. It was the largest corporate collapse America had ever seen. 20,000 employees lost their jobs overnight. Many lost their entire life savings. Their retirement funds had been locked in Enron stock. As the stock died, they could only watch. The fall of Enron triggered a massive investigation. One by one, its leaders faced justice. Andrew Fastow, the architect of the secret entities, cooperated. He served around 5 years in prison. Jeffrey Skilling was convicted on multiple counts. He was sentenced to 24 years behind bars. Kenneth, the founder, was also found guilty. But before he could be sentenced, he died of a heart attack. His conviction was erased, as if it never happened. And Arthur Andersen, one of the world's great firms, was destroyed. 85,000 jobs gone worldwide. Enron didn't just destroy itself. It shattered America's trust in big business. In response, the government passed a landmark law. Sarbanes-Oxley Act changed corporate accounting forever. Companies could no longer hide debt so easily. Auditors were forced to become truly independent. Enron became the textbook example of corporate fraud, a warning taught in business schools to this day. Enron's downfall wasn't really about energy or accounting. It was about a culture that worshipped the stock price, where looking successful mattered more than being honest. When a company's profits are impossible to understand, that complexity is not genius. It is a warning. Ask the simple question the experts forgot. Where exactly is the real money? If this story gripped you, subscribe to The Fraud Terrain and tell us, which case should we investigate next?